We use money every single day, yet it's difficult to explain our behavior with it using formulas or charts. Humans are emotional beings, which is why it's important to understand how our minds shape our financial decisions. Our history, aspirations, and fears all influence how we use money. Today, I'm going to talk about the book, The Psychology of Money, and I'll share the 10 points that stood out to me the most. First, wealth is what you don't see. True wealth is not what you see on social media. It's not luxury cars, mansions, or expensive watches. Those are not signs of wealth. They are signs of spending. Real wealth is the money you haven't spent. It's the investments growing quietly and the savings that no one sees. Every time you see someone spending a lot, what you're seeing is consumption, not wealth. Think about it this way. When you see someone driving a $100,000 sports car, you're not seeing wealth. You're seeing someone who chose to spend $100,000 on a car instead of investing it. The truly wealthy person might be driving an ordinary car while their investments are generating returns that exceed the $100,000 sports car. Avoid spending to impress others. Focus on saving to gain options, peace of mind, and independence. Second, building wealth depends more on saving than on returns. Obsessing over finding the next big investment can distract you from the most powerful foundation of wealth building: saving. Over the long term, saving 20% of your income and investing it with conservative returns will take you further than saving 5% with aggressive investment strategies. The math is simple. If you earn $50,000 a year and save 10%, that's $5,000 annually. A 10% return would give you $500 extra. But if you increase your savings rate to 15%, you go from saving $5,000 to $7,500, which would generate $750 extra without changing your investment strategy at all. Obsessing early on about maximizing returns is like worrying about the aerodynamics of a car that has an empty gas tank. Savings are the fuel of wealth. Without it, it doesn't matter how advanced your investment vehicle is. Third, the freedom to choose is the greatest luxury money can buy. The ultimate goal of money shouldn't be accumulating more things. It should be accumulating more control over your life. True wealth allows you to say no to things you don't want to do and yes to the things you truly value. Imagine being able to quit a toxic job, work on a project without worrying about immediate profitability, or spend time with your family when they need you. When managed properly, money buys something more valuable than possessions: freedom, control over your time, and the ability to live life on your own terms. Financial decisions that prioritize long-term freedom are the ones that truly matter, far more than any material possession. This freedom is the real sign of wealth, much more than any status symbol. Fourth, save like a pessimist, invest like an optimist. The key is preparing for hard times while believing in progress. Save as if the world could collapse tomorrow. Build a strong financial cushion that protects you from emergencies or unexpected changes. But once that foundation is secure, invest with the mindset that the future will be better than the present. No matter the wars, pandemics, or economic crises, people will continue innovating, economies will continue growing, and opportunities will continue emerging, just as they have throughout history. This combination protects you on the pessimistic side from short-term risks, while allowing you to participate in long-term growth on the optimistic side. Fifth, good investments aren't necessarily complex. There's a common belief that the most elaborate and complex investment strategies deliver the best results. In reality, the best strategies are often boring. Save consistently, diversify, keep costs low, and invest for the long term. Warren Buffett, perhaps the most successful investor in history, built his empire on basic principles applied with discipline over decades. You don't need secret formulas. You don't need to predict every market movement. You need to follow simple principles with discipline. The best financial strategies are the ones you can explain to a 10-year-old and keep applying for 50 years through different economic cycles and personal circumstances. Avoid the temptation to chase shortcuts or believe in gurus with magical formulas. Simplicity and consistency are usually the keys to success. Sixth, plan for failure and surprises. Financial history is full of unexpected events that no one could predict. No one foresaw world wars, the digital revolution, or a global pandemic. Uncertainty is an inevitable part of life and financial markets. It's not about predicting what will go wrong, it's about accepting that something at some point will go wrong. This means maintaining a solid emergency fund, avoiding excessive debt that limits your flexibility, diversifying your investments, staying calm during volatility. Good planning isn't about predicting the future, it's about preparing for different possible futures. Seventh, define your own financial goals. We live in a society driven by comparison, especially when it comes to money, and even more so with social media. Nothing is more financially self-destructive than comparing yourself to people who have different goals, values, and circumstances than yours. Every person has different financial starting points, different definitions of success, and different tolerances for risk and uncertainty. What does success mean to you? Set your own rules. Build your own plan. Because personal finance is not a competition, it's a personal construction. Define your financial goals on your own terms, based on what you truly value, not on what impresses others. Eighth, financial success doesn't require brilliance, but common sense and patience. Financial history is full of geniuses who failed. The hedge fund long-term capital management was managed by two Nobel Prize-winning economists and collapsed in 1998 after losing $4.6 billion in less than 4 months. Brilliance doesn't guarantee financial success. In fact, it can sometimes be dangerous if it leads to overconfidence. What truly matters is common sense, making rational decisions and avoiding impulsive behavior, and patience. Sticking to a long-term strategy and allowing time to work its magic through compound interest. Financially speaking, it's more important not to go broke than to be brilliant. Avoiding major mistakes has a greater impact than occasionally making brilliant decisions. It's not about being the smartest person in the room. It's about being consistent and avoiding costly errors. Ninth, use money to gain control over your time. Every financial decision you make should move you closer to, not further from, controlling your time. The scarcest resource in life is not money, it's time. Money can be recovered. Time, once it passes, is gone forever. If your lifestyle grows faster than your income and your spending forces you to stay in a job you hate, money isn't buying freedom, it's buying slavery. Don't use money to buy things. Use it to buy time. Because time is what truly matters. 10th, being rich means having options. Being rich is not about accumulating a large amount of money. True wealth is having options. The ability to change jobs if you don't like yours, to move if necessary, to pay unexpected expenses without going into debt, and the freedom to change your mind as your priorities evolve. The best financial strategy isn't the one that maximizes every dollar. It's the one that gives you the most options to respond to a future you cannot predict. Wealth isn't just what you can buy today, it's the possibilities you will have tomorrow.